So think about that, right? You take out the $20,000 now, you're risking potentially $150,000 to $200,000 in the future when you retire.
Yeah. Hi, and welcome to Coffee with Confio. I'm William Freitas, and today's topic is early access to super. Should you withdraw $20,000 from your superannuation account, especially after the coronavirus? Today we've got Eti Amegor on the show. Eti Amegor comes from Axios Partners. He's an investor as well. We're going to call him an investment guru here. So welcome on the show, Eti. It's good to have you.
Wouldn't quite say investment guru, but I know enough, I guess you could say.
Throw him under the bus.
Yeah, exactly. But no, thanks for having me.
Great to have you. This is not investment advice. We're going to put it out there very early.
Disclaimer.
But we're going to be chatting to Eti, particularly around super. But before we do that, can you tell us a little bit about what you do day to day?
Yeah, good question. I guess we do a bunch of things. As you said, I work for a business called Axios Partners. I'm currently an associate director there. Fundamentally, I'm in the funds management space. So we work with a whole range of different asset classes. So Australian equities, private equity, hedge funds, property, all sorts of things. What I specifically do day to day is to raise capital and structure deals, essentially. So we tend to raise anywhere from, say $20 million upwards of $1 billion to be put into investment funds or investment vehicles. We also incubate funds as well. So we take equity stakes in fund managers. For example, we have an equity stake in an Australian funds manager. And my two bosses do, and we help build that business. So we essentially help build funds management businesses, and that is across the whole spectrum. So basically everything apart from literally picking the stocks. However, obviously we need to understand that to the nth degree, because for us to obviously go out there and convince superannuation funds, institutional investors to invest with us, we need to really, really understand our concept, the concept that we're actually trying to get across. And then we also do some property advisory as well. So in short, that's
and
a
you've
bit
got a
about what I
master's
do.
in finance, is it?
Yeah, so I got a bachelor's of business, Macquarie, where I met you, Macquarie University. And I also have a master's of commerce from Sydney Uni, and I'm halfway through my CFA, my Chartered Financial Analyst accreditation as well.
Cool.
Yeah.
And so we brought Eti on the show specifically to talk to us about super, right? So we've obviously seen that the government's come out with an incentive that if you've been impacted, if you or your business has been impacted, you can access your superannuation early. Now you can get $10,000 before 30 June 2020, and then you can get another $10,000 just after that. Now we're asking Eti the hard question, or an easy question for you. Should people take out that $20,000?
In my opinion, no.
Okay.
All right. So again, I'll make the disclaimer. Before you make the decision, speak to a financial advisor or any sort of professional, because everyone's situation is different. However, if you sort of just look at the facts, it's not really something that you really want to be doing right now unless you are in a drastic position. Okay, so obviously, as we've seen, COVID-19 has unfortunately made a lot of people lose their jobs, has put a lot of people in a lot of financial hardship. But fortunately, the government has stepped in and have introduced some new initiatives, such as like the Job Seeker initiative, and there's a lot of small business initiatives, with the Pay AYG and the tax restructuring that people can actually utilize in order to reap some sort of money back, from the money that they've lost. Now, I would always suggest look into those initiatives first before going into your superannuation. I think your superannuation is like your last-ditched effort. If everything else, if everything has failed and maybe you're in a position where your debt's piling up, or something's happening and you really need that money, then maybe you can take out the superannuation. So, in short, no.
I guess it's all obviously dependent on everyone's situation, as you can hear and understand. But there's definitely some long-term impacts, right? What are the impacts put shortly if people do pull out their superannuation?
Yeah, well, good question, because a few things I want to touch on. Number one is the locking in of losses.
Yeah.
Okay, so especially millennials and Gen Ys, people our age and so forth, basically anyone that's on a baby boomer doesn't really understand superannuation. We've had a fundamental issue in our society where the superannuation industry hasn't really educated enough of the population for us to really understand it.
Yeah.
Because let me tell you, most of my friends don't even know how much super they have. They don't even know where their super is. Some of them don't even know what superannuation is at all. It's like, what? Yeah. What do you mean I've got superannuation?
Well, they'll be shocked to know that their super account is probably down by 20% in the last few months.
That's exactly right. So to touch on the locking in of losses, because a lot of people don't realise that they've already got a lot of exposure to equities in their underlying superannuation account. Because if you do a quick research, like you just find out where your super is, go on there, just say if it's in Sun Super or Australian Super, go on the annual report, look at what you can actually see, what investment, what vehicle you're in, whether it's a balanced account, a high growth account, all that sort of stuff.
Yeah.
You can essentially see the percentage that's allocated to equities. And typically on a balanced account, and for most people, we have about a 50% allocation to equities, so about 26% in global equities, and about 24 or so percent in Australian equities. That's a big exposure to equities. Yep. Now we've all seen the markets have gotten smashed. They've been smashed, right? So it essentially means that you've been affected as well.
Yeah.
Right. So if you look at it, if the market's dropped 30%, most likely you've probably dropped around that as well. So if you take your super out now, you're essentially locking in a loss, right? It's like purchasing an apartment or a house at the top of the cycle and then selling it at the bottom of the cycle.
Exactly.
You know what I mean? You're taking money off the table.
It's a great way to put it, right? Because no one's going to want to sell their property at the lowest end of the market. It's the exact same with equities or as shares, otherwise known. So you don't want to be selling at the bottom of the market unless you really have to. That's right. So that's the not the advice, because it's not advice, but that's the recommendation. Just be mindful of when you're doing things and why you're doing it for. But I'm going to be a little bit cheeky here for the savvy business owner sitting back home and going, okay, well, Eti, why don't I just pull out that $20,000 from my superannuation account and then just invest that money personally as well? I might be locking my losses here on my superannuation, but I'm going to buy at the same end of town, I guess, in the market personally. Why would you or why would you not?
Yeah, good question. Now, before I answer that, I also want to touch on for the audience out there that you also have to look at the long-term effect of taking your money out of your super. There's been a lot of sort of financial studies that have shown what the long-term effects may be. I was reading one where essentially if you're a 30-year-old or a 20-year-old, just say you're a 20-year-old individual and you take out the $20,000 now, by the time you retire, you could potentially be losing upwards of 150 to 200 grand of your super by the time you retire. So think about that, right? You take out the $20,000 now, you're risking potentially $150,000 to $200,000 in the future when you retire.
Yeah.
If you think like that, it makes a bit of sense. Like,
I don't know what the average, superannuation total is when you retire, but it's a fair bit of the chunk, I'd say.
Of course,
that you're going to miss out on.
100%, right? So, and it could be even higher depending on how much you earn and where the markets go. But that's something that you've got to think of. Now, I guess in terms of should you pull out your money and invest in other, in property or in other vehicles, the way I see it is this. Number one, they are very capable individuals at superannuation funds and investment teams who've been doing this thing for 30 plus years, right? These guys are investors, like professionals, you know what I mean? If you can honestly say that I can take out all my super and I can get a better return over the next 30, 40, depending how old you are, 30, 40, 50 years than those individuals, go for it. That's up to you. If you think you're smarter than them and you can do it, go for it. However, if you don't think you can, or you don't have much investment experience, or you've never done this before and you think you're just going to take out $20,000 and put it somewhere, and then okay, you're going to beat them.
Yeah.
Then,
Become the
you know
Warren
what I mean?
Buffett of the world.
That's right.
Yeah.
You know what I mean? Then don't. So I say this: you're paying a very low price for a team of investment professionals to manage your money.
Yeah.
It's very low. Like you may be charged, I don't know what, $100 a year, $20 for everything, insurance, the fees, all that sort of stuff. You know, every fund has their own structure, but it's very, very low for professionals to do it. You know, if you were to get a professional as one person to pay them, you have to pay them $200,000 a year for them to invest just your money, right?
Yeah.
You've got a team of them doing it for like $100 a year.
Exactly.
You know what I mean? So if you can honestly say that you're better than them, go for it. That's my advice.
Yeah, perfect. And I mean, the interesting thing is, particularly with super and investing, it's a great timely example for business owners, anyone there with a superannuation account. Have a look at what your fund is returning on average. And to be honest, they're probably returning a little bit more than what you could do personally. Not saying that, you couldn't do better.
Yeah, of course.
But there are a lot of personal investors who are not getting great returns. And if you're just buying one or two stocks, you and I were having a chat a few days earlier.
Exactly.
Are you diversifying your stocks?
That is another good point, because when you have your money in superannuation, effectively it's diversified. If you're in a balanced account, you've got 26% exposure to global equities, you've got 24% exposure to Aussie equities, you may have another, 10% to alternatives, whatever it is. So it's automatically diversified. You know what I mean? So unless you are, an investment professional and you understand what you're doing, in order to actually get an efficient, diversified portfolio where you've got exposure to everything that you have in a superannuation account, like it's pretty easy decision for me, right? If you want to minimize your risk, then just keep it in super. It's already diversified. 100%. And I know a lot of people will take out their money and they'll go in a couple of stocks or one property. Yeah. Or whatever it is, depending on how much.
Which is not ideal, obviously.
Well, yeah, I mean, you're effectively betting your retirement fund on like a couple of investment vehicles.
It's more risky.
Yeah, it's again, everyone's different, but if you compare it to a highly diversified, balanced account, I mean, it's way more risky than that.
Yeah. Exactly. I think we're going to have to get Eti back on the show to talk about investment, because we could touch on a whole other aspect there. But that pretty much sums up superannuation in the sense that just be mindful for when you are pulling it out. Do you need that money? Be mindful of what your returns are, and know that the professionals are looking after that money, and there's a serious impact long term for your total sum. So it can really impact you negatively in retirement. So Eti, thank you for coming on the show.
Pleasure.
We can't let you get off the show without the Confio confession.
That's right, I was told about this.
Something that we don't know about you.
I guess what a lot of people may not know about me is that, you obviously knew I played a lot of football in the past, soccer for people who don't call it football.
Yeah, the world game.
The world game, football. But I represented Australia in 2008 in football. I was actually pretty good back in the day, pretty good. And I was fortunate enough to play in Japan and South Korea.
Awesome.
Actually, interesting fact. It may not look like a soccer player.
Did you stop because of an injury, or was it?
Yeah, I snapped my kneecap in half.
Yeah, it's like every other footballer. You were going to have a career. You could have been the next Cristiano Ronaldo.
Of course.
Yeah.
yeah.
I was definitely in that boat. Guys, thank you for tuning in to Coffee with Confio. Again, this is Eti. We'll definitely get him back on the show. If you have any questions for us, particularly around superannuation, feel free to reach out to us on any of our socials. You'll find Eti on his Instagram, which is Eti Amegor?
Yeah, Eti Amegor. However, that's a private one.
Okay.
You can use my podcast Instagram, which is Suits and Kicks. Literally SUITSAND-KICKS, Suits and Kicks.
And we've got a lot to talk to Eti about. We're going to get him back on, probably about investment. I might even get you back on for the podcast, and we'll chat about that a little bit further.
I'm in your hands, my friend.
Cool,
Thank
man.
you.
All right, thank you guys. Thank you for tuning in. Chat soon.